One of the biggest pricing mistakes that I see trade and construction business owners making is confusing the relationship between markup and margin. And what this typically looks like is going into a job, working out what it's going to cost to deliver it, then slapping on a 50% markup, thinking that you're going to make a 50% gross profit margin. But this isn't the case at all. In fact, in this instance, if everything goes to plan, you're actually only going to make a 33% gross profit margin despite marking up your job costs by the 50%. Now, if you're not sure why that's the case, then this video is for you. I'm going to break down exactly what the difference between markup and margin is, why you need to know this when you're pricing your jobs and projects, and exactly how you can start making thousands and thousands of dollars worth of more profit moving forward. For those who don't know me, my name is Bayley Peachey. I'm a client advisor at Trade Business Accountants, and we help trade and construction businesses typically turning $1 to $10 million a year dramatically increase their profits and cash. Let's dive in. Okay, so first things first, markup and margin are not the same thing. I often hear people saying things like, hey, I've added a 15% margin to my labor and my materials. But oftentimes in these cases, they're actually talking about markup, and that is costing them a lot of money on their job. So what is the difference between the two? Well, margin refers to the percentage of sales revenue that is gross profit. It is your gross profit margin. Now, for those of you who don't know what gross profit is, it's simply the profit that's left over after you minus all the costs to deliver the job from the total selling price, right? So let's say, for example, that you sold a job for $1,000 and it costs $600 to deliver it through labor, materials, and so on. And that then leaves you with $400. That $400 is gross profit. So in this case, from a $1,000 job, $400 in gross profit, you have a 40% gross profit margin. Now, to calculate your gross profit margin, we use this formula: total sales price minus total costs divided by the total sale price equals your gross margin. Whereas markup, on the other hand, refers to the percentage that your job costs, like your labor, your materials, and so on, are increased or marked up to give you your total selling price that sits on the quotes that you give to your clients and your customers. And this markup can be completely random, but for best practice, it should be based on a specific predetermined gross profit margin, which we'll touch on in a moment, right? Because this way, markup then becomes a tool that helps you to price your jobs for a specific gross profit margin to make you the money that you actually want to earn. So to calculate our markup, we use the following formula: total sales price minus the total costs divided by the total cost equals your markup. And that's the difference between markup and margin. Now, if we confuse the two of these, we can actually fool ourselves into thinking that we're going to be making a much better profit margin on our jobs and projects than we really are. And the best way to understand this is through an example. So let's say, for example's sake, you're quoting a job and you estimate there to be $10,000 worth of direct job costs. So across your labor, materials, equipment hire, what have you, $10,000 is what you estimate to be the costs of that job. Now, if you were to mark up these job costs by 50%, that would mean that your gross profit margin on this job would come to $5,000, because $10,000 times 50% equals $5,000. And so that 50% markup makes the total quote, or the final sales price of your job, $15,000. So $10,000 in cost and $5,000 in gross profit from our 50% markup. But this does not mean that we're making 50% profit. In fact, our gross profit on this job is actually only 33%. And this is because the $5,000 in gross profit is 33% of the total sale price of $15,000. So by marking up our job by 50%, that allowed us to make a 33% gross profit margin. And so the problem here is that if you don't understand the difference between markup and margin, and you think that marking up your job by 50% will mean that you will achieve 50% gross profit margin, you're actually making 17% less profit than you think you are. Because the 33% is what you get to keep, not the 50% that you thought you were going to get. So it's no wonder why so many trade business owners out there are pricing jobs. They're thinking that there's a lot of fat in them, but once they finish the job, they collect their money from their customers, and then they look at their bank account. What they expected to be there just isn't there, right? So it's all because they're confusing their markup with their margin. And this is why that relationship is so important to understand when you're pricing your jobs. Because if you change the way that you're pricing to focus solely on margin and then using markup really just as a tool to get to that specific margin, rather than thinking that markup is your margin, then you're going to make significantly more money in your business. Now, circling back to what I said at the start, and really in alignment with all of this, what you actually want to be doing is setting gross profit margin targets for your different work types before you even worry about what markup you should be putting on your jobs. You need to establish benchmark gross profit targets based off how much money you want to earn in the year and what your overheads are. So for example, you might want to earn $300,000 in operating profit. So 300 grand in pre-tax profit, and you might have $800,000 in overheads. This would then make your gross profit target $1.1 billion. Then to get your percentage, you estimate that, hey, you're going to do $3 million in sales over the next 12 months. And then you divide your $1.1 million gross profit by your estimated $3 million in sales. And then this will then give you a 37% gross profit margin target. This way, you have a profit target that you're aiming for on your jobs and your projects before you even pull the trigger on any quotes. And this is really important because without a target, you don't know what to aim for. And so when you're quoting a job, your markup is likely just going to be some random amount with no real strategy behind it. And this is going to be costing you big time. Even if you're doing okay right now, I guarantee that you could be doing significantly better if you get clear on your numbers before you even start pricing your job. So you need to start with the end in mind. How much money do you want to actually earn this year, right? Because factoring in your overhead costs and how much money that you want to earn at the start with these targets ensures that you're pricing at the right margins every time, or at least close enough to cover your costs and make the profit that you want. And this understanding, and these targets, they're the key to really just exploding the profits in your business. Because if you're not doing this right now and you change this approach, you're going to make significantly more money in your business. And so that's the next step. Now, once we've hit that and you know what gross profit margin you need to be aiming for, you now need to know what markup that you should be using on your jobs and your projects to hit that target. Because like I was saying earlier, if you were to just add a 37% markup to your job cost because you need to hit a 30% gross profit margin, this isn't going to get you anywhere, right? So to calculate the markup that you need to use, we use the following equation: markup divided by 1 minus margin in the brackets. And then to calculate your total quote price, we use the following equation: costs times 1 plus markup in your brackets. And continuing on with our example, so we need to hit a 37% gross profit margin. So our markup would be 0.37 divided by 1 minus 0.37 equals 0.59 or 59% if we times it by 100. So then our total quote price will be $10,000 times 1 plus 0.59 equaling $15,900. So if we go into that price, we're covering our overheads, we're hitting the margin that we need to be earning the amount of money that we want to earn across the projected year, which was $300,000 operating profit, right? So at the end of the day, markup is just a tool to help you price for margin. A profitable quote isn't just about adding a random percentage to your job cost. It has to be precise to what you're looking to achieve. Otherwise, you're just not going to get the results that you really should be in your business. And once you've established that, so you understand the difference between markup and margin, and you're pricing now based off gross profit margin targets, and you know what markup you need to use to hit those targets, now you want to know if you're actually making that profit on your jobs. And this is where back costing comes into play. Back costing is the process of comparing what profit we actually made on a job or a project with what we originally estimated that we'd make. So it's basically just comparing our original quote with what actually happened. How much profit did we expect to make versus how much profit did we actually make? And this is really, really important to get that feedback loop of how we're going on our jobs, because it's all well and good to go in and quote a job at 50% gross profit margin. But if we're only making 20%, or even worse, we're losing money, then we need to know, and more importantly, we need to know why. It could be an estimation error where we're not allowing for enough on the jobs. It could be blowouts in delivery or inefficiency from our crews. It could be, wastage of materials, whatever the reason. Getting that feedback loop on how you're actually performing, it's really important because it's going to allow us to adjust and better prepare to get it on the next one. So we can continually improve and make sure that we're earning the money that we're expecting or anticipating to earn on our jobs. And a really good example of this is one of our plumbing clients. So when we first started working together, he didn't really understand the difference between markup and margin, and he wasn't sure what gross profit that he was making on his jobs. And so all he would really focus on from a numbers perspective was how many sales that he was making every month. And that's a dangerous trap to fall into, because sales is a vanity metric, right? It's far more important what profit we're making, because gross profit is the engine room of your business. And it matters a lot more than just how many sales we're making, right? So when we back costed his jobs, what we discovered was that he wasn't making enough, one, but two, and this is really important, there was no real consistency to how he was pricing. And that's really, really important to understand. There was no consistency in how he was pricing these jobs, right? So here are some of his gross profit margins from the jobs that we back costed. 26%, 45%, 24%, 38%. We've got 10% in there, 22%, 17%, then 28%, then 42%. It was all over the place. And so after establishing how much money he actually wanted to earn, what his overheads were, and then his gross profit margin targets. Just like I've spoken about in this video, in a matter of months, he was back growing his top line sales, but now with far greater profits. In fact, his gross profit margin across every job was either 50%, 60%, or even up to 70%. And most impressively, never dropping below 50%. So this is why it's also important that you not only understand markup and margin, but you also back cost your jobs so you understand how you're really going. Because just like our client here, you too could be leaving significant amounts of money on the table if you don't know this stuff. As simple as it is, not enough people are back costing their jobs. You need to be across the stuff, get that feedback loop, and continue to improve every single job to earn the money that you should be. So to summarize, markup and margin are not the same thing. When pricing jobs, focus on margin and then using markup as a tool to get there. Base your gross profit margin on jobs off of preset targets and back cost all of your jobs and projects to see how you're actually performing. If you follow these steps, you will be well on your way to making a lot more money in your trading construction business. I promise you. Please, please, please focus on this stuff if you're not across it. And to help you get started with everything that we've just discussed today, I've actually put together a bit of a cheat sheet, right, that you can download for free from the link in the description below this video. This cheat sheet has all the notes on what markup and margin are. It has the examples that we covered, and it even has a table showcasing exactly what markup to use for any specific gross profit margin target. So you don't even have to worry about the maths. I encourage that you do understand it and you can go through those notes, but I've got the cheat sheet here with the table to help you anyway. It's completely free to download, so definitely be sure to check that out and get your hands on a copy. And with that being said, I hope you've enjoyed this video. If you have any feedback or questions, please let me know in the comments below. I'd love to hear from you. Like and subscribe if you haven't already for more content just like this every single week. And I will see you in the next one.